Normally you look at an oil field services company and, you expect to see drills, rigs, maybe crude oil.
Right, the usual heavy metal.
Exactly. But today, we are looking at Baker Hughes' Q2 2026 earnings. And honestly, we're seeing the physical engine room of the AI revolution.
Which is a complete paradigm shift.
It really is. So welcome to Talk Tickers. And as you know, our usual mission here is a rapid, data-forward, under 5-minute sprint through the numbers, right?
Yep, translating the Wall Street jargon.
Exactly, into plain language to see if a stock is a buy, hold, or sell for you, the retail investor.
Okay.
But today we are throwing that clock completely out the window.
We kind of have to.
Yeah, we do. The structural pivot happening inside Baker Hughes, ticker symbol BKR, by the way, it is so massive, so complex, and honestly, so indicative of where global capital is flowing right now.
Yeah, doing a 5-minute summary would be, and basically be analytical malpractice.
100%. So we are going full deep dive.
And it is a strictly necessary shift in our format because, the traditional mental model most investors have for Baker Hughes, it's officially obsolete.
Yeah, you really have to throw it out.
You do. If you are holding this stock right now, or, maybe you're evaluating an entry position, analyzing them purely as an upstream oil and gas service provider is going to lead you to entirely misprice the asset.
Because they aren't just doing that anymore.
Exactly. We are dealing with an industrial transition here that touches the absolute deepest bottlenecks of the current tech boom.
Which is exactly why we need to unpack the data, literally line by line.
Let's do it.
So we are going to hit the headline numbers, dissect the, frankly, explosive growth in their energy technology division, stress test management's forward guidance, and give you a definitive verdict on the other side.
Sounds like a plan.
Let's start right at the top. The Q2 2026 headline numbers. The top line metrics were undeniably strong. They reported adjusted EBITDA of $1.23 billion.
Which is a massive number on its own.
It is. And the critical context here is that this didn't just meet consensus. It actually blew past the high end of their own internal guidance range.
And see, that specific detail exceeding the high end of their guidance, that is arguably the most important signal from the top line data.
Why is that the most important part?
Because management teams in the heavy industrial sector are, by their very nature, structurally conservative.
Right. They don't want to overpromise.
Exactly. When they provide a guidance range, they are heavily incentivized to guide to a number they have, say, an 80 to 90% probability of hitting.
So they usually just aim for the midpoint, right?
Yeah, the midpoint is safe. So to overshoot the very top end of that range, that implies that the operational momentum, the pricing power, or, the project execution velocity accelerated in a way that even their own internal forecasters failed to fully model.
They basically surprised themselves.
They absolutely did.
Wow. And when you flow that down to the bottom line, we saw adjusted EPS earnings per share come in at 64 cents.
Right.
That's up about 2% year over year. Which, on the surface, a 2% EPS bump doesn't really look like hypergrowth.
No, it looks pretty modest.
But you have to factor in the structural changes they made over the last 12 months. Because they achieved that growth despite the massive revenue hole left by the recent PSI divestiture.
Right, and the formation of that new joint venture.
Exactly. So their core operational leverage was literally strong enough to outrun the missing revenue from the units they carved out.
Which is super impressive. And honestly, the earnings quality is what really stands out to me here.
How so?
Well, you can engineer a modest EPS beat through, share buybacks or one-time tax adjustments.
Right, Wall Street accounting tricks.
Exactly. But you cannot fake free cash flow.
No, cash is cash.
And they generated $1.1 billion in free cash flow during the second quarter alone.
Just in one quarter. That's wild.
Yeah. And that cash generation was driven heavily by working capital improvements and, crucially, milestone and advance payments on these massive new projects.
Oh, advance payments. That dynamic is a huge competitive advantage in the current interest rate environment.
It's basically the holy grail of manufacturing right now.
Right, because if you are pulling in hundreds of millions in advance cash from your customers before you even finish building the equipment.
You are effectively getting zero-cost financing.
Exactly. You're getting the clients to fund your own manufacturing. It's brilliant. But I think the metric that really anchors the strength of this quarter is the margin profile.
Oh, the margins were incredible.
They really were. They expanded their adjusted EBITDA margin by 70 basis points year over year.
Hitting a record 18.3%.
Right. And expanding margins by 70 basis points in a heavy industrial sector right now. That is incredibly rare.
It really is. It speaks to immense pricing power.
Because costs are up everywhere else, right?
Exactly. I mean, think about it. We are operating in a 2026 macroeconomic environment where logistics costs remain elevated, skilled manufacturing labor is, really expensive.
And hard to find.
Right. Plus, the supply chain for complex metallurgy and heavy industrial components is still highly constrained.
So for Baker Hughes to widen their margins to 18.3% in that environment,
it means their end products are so mission critical and the demand is so inelastic that they can pass every single basis point of their internal cost inflation directly onto the customer.
and the customer just pays it.
Happily pays it just to secure their place in line.
Wow. Which brings us to the absolute stunner metric of the call. Because if you stop at the headline numbers, solid EBITDA beat, record margins, it looks like a phenomenally executed quarter for a legacy energy company.
Just a really good quarter.
Right. But the real story is in the IET segment.
Industrial and energy technology.
Exactly. This is the equipment and advanced engineering side of the house. And the numbers here are, frankly, borderline incomprehensible for a company of this vintage.
They really are?
IET orders doubled year over year to a record $7.1 billion in a single quarter.
The scale of that sequential acceleration is just staggering. I mean, to contextualize it, their previous all-time record for a single quarter was $4.9 billion.
Okay.
And they just set that record last quarter.
So they didn't just beat their best quarter ever.
No, they obliterated it by over $2 billion.
That is insane.
It is. If you look at the trailing 12 months, the IET segment has secured more than $20 billion in new orders.
$20 billion. And management quantified this demand explosion on the call by noting it drove a 2.2 times book-to-bill ratio for the quarter.
Which we should probably translate for the listener.
Yeah, let's break that down. In heavy manufacturing, a 1.2 ratio is usually a sign of a very healthy growing business, right?
Yeah, absolutely.
Because you are replacing the inventory you ship out and adding like 20% to the backlog.
It means you're growing comfortably.
Right. But a 2.2 book-to-bill ratio, that means for every single dollar of equipment they finished, shipped, and billed for in Q2, they signed legally binding contracts for $2.20 of brand new work. The pipeline is basically compounding at a breakneck pace. Think of it like a contractor. For every one job they finish, they're booking 2.2 new ones.
And the direct financial output of that book-to-bill ratio is their remaining performance obligations, or RPO.
Right, the backlog.
Exactly. Because of this $7.1 billion influx, their total RPO skyrocketed 19% sequentially.
To an all-time high of $37.1 billion.
That is $37.1 billion of contracted high-margin revenue, literally locked in the vault, just waiting to be manufactured and recognized on the income statement over the coming years.
It's basically a massive safety net.
It is. That RPO figure represents the ultimate downside protection for the stock.
Because even if things go south.
Exactly. If the global economy enters a severe recession tomorrow, Baker Hughes still has $37 billion of contracted work to keep their factories running at maximum capacity for years.
Okay, but this begs the underlying question.
Right.
A $7.1 billion quarter doesn't just materialize out of thin air. You don't double your order book by, selling standard drill bits.
Yeah, definitely not.
So what is the fundamental catalyst actually driving this buying frenzy?
The catalyst is a massive structural pivot into power systems.
Power generation.
Specifically, power generation designed to feed the artificial intelligence and data center market.
Okay, pause. This is where I want to drill down into the mechanics, because this is where the traditional thesis completely breaks.
Yep, this is the pivot.
Baker Hughes is a Houston-based energy technology company. Why in the world are Silicon Valley tech giants, the hyperscalers, suddenly becoming their largest customers?
It's a great question.
We really need to understand the physics of the problem these tech companies are trying to solve here. Because out of that $7.1 billion, what was the data center slice?
Well, of the $2.6 billion in power systems orders they booked within that broader IET segment, a staggering $2.2 billion came directly from data center operators and their infrastructure partners.
$2.2 billion strictly from tech.
Strictly from tech. And to understand why, it comes down to the brutal physical reality of artificial intelligence.
Because AI takes a lot of juice.
An unbelievable amount. We often use the term cloud computing, which, implies something weightless and ethereal.
Like it's just floating in the sky.
Right. But Training massive language models and running AI inference workloads requires fleets of highly advanced GPUs.
Chips like the NVIDIA H100s, right?
Exactly. Or the newer B200 architectures. And these chips consume an exorbitant amount of electricity.
How much are we talking?
Well, we are moving from traditional data center racks that might draw, say, 10 to 15 kilowatts of power
Right.
to high-density AI racks that can draw upwards of 100 to 120 kilowatts per rack.
Wait, really? Per rack?
Yes, the power density is multiplying exponentially.
So 10 times the power draw in the exact same physical space.
Exactly. And the traditional public utility grid simply wasn't designed for localized, hyperdense power sinks of this magnitude.
Because they're just too big.
Right. If Microsoft or Amazon wants to drop a new 1 gigawatt AI data center in a specific region, they can't just call the local utility and ask them to run a wire.
Hey, plug us in. Yeah, that doesn't work.
It doesn't work at all. The utility would have to upgrade substations, build massive new high-voltage transmission lines, and, navigate years of environmental permitting and regulatory approvals.
Oh, the red tape alone.
It takes forever. The grid interconnection queue in many major markets is now 5 to 7 years long.
5 to 7 years just to get permission to plug in.
Exactly. And if you are a hyperscaler locked in an arms race for AI supremacy, you literally cannot wait until 2033 to power up your next data center.
Because speed to market is the entire competitive advantage.
Precisely. So they are taking matters into their own hands by going what they call behind the meter.
Meaning they are severing their total reliance on the public utility grid.
Yes.
They are buying the physical hardware to build captive, localized power plants right next to their server farms.
Exactly. They are generating their own electricity on-site. And this is the exact market Baker Hughes is capturing.
Okay, so what exactly is Baker Hughes selling them?
Baker Hughes manufactures highly advanced heavy-duty gas turbines, things like their Novia LT series and their aeroderivative frame turbines.
And they are selling these directly to the tech ecosystem.
They're selling these massive power generation units directly to the hyperscalers and the data center developers.
And the Q2 transcript completely validates this thesis because they announced some massive individual project awards.
They really did.
Like they highlighted a 1.3 gigawatt order from a company called Dynamis for mobile power generation utilizing those Novia LT gas turbines you mentioned.
Right. A 1.3 gigawatt order.
And just to ground that number for the listener, 1 gigawatt is roughly the total power consumption of a mid-sized American city.
It's a massive amount of power.
So Dynamis just bought 1.3 cities worth of electricity generation in a single purchase order.
Yep. And the mobility aspect of the Dynamis order is crucial here.
Why is mobile so important?
Because these aren't traditional combined cycle gas plants. The kind that require massive concrete foundations, cooling towers, and 3 years of heavy civil engineering to construct.
Right, these are different.
These are aero-derivative turbines. The core technology is essentially a highly modified aircraft jet engine strapped to a skid and coupled with a generator.
Wow, a jet engine on a skid.
Pretty much. And because of that design, they can be shipped to a site, connected to a natural gas line, and spun up to provide immediate, reliable baseload power relatively quickly.
Which completely bypasses that 5 to 7 year utility wait time.
Exactly. That modularity and speed of deployment is exactly what the data center market demands.
And Dynamis wasn't the only one. They also announced a multi-year strategic agreement with Kodiak Gas Services.
Yeah, that's another big one.
That one is anchored by an initial award for roughly 1 gigawatt of power generation capacity, but it has a framework built in to expand it up to 1.8 gigawatts over time.
So between just Dynamis and Kodiak.
Right, Baker Hughes secured visibility on over 3 gigawatts of power generation demand just from those two deals.
And management really contextualized this localized demand against the broader macro outlook on the call.
Using the S&P Global numbers, right?
Yes. S&P Global is currently projecting that global data center power demand will grow at an 18% compound annual growth rate through 2030.
18% every year.
Every single year. If that CAGR holds, data centers alone will consume approximately 1,850 terawatt hours of electricity by the end of the decade.
1,850 terawatt hours. The CEO, Lorenzo Simonelli, made a comparison on the call that really highlights the sheer scale of that energy footprint.
Yeah, the India comparison.
Exactly. He pointed out that 1,850 terawatt hours is roughly equivalent to the entire preeminent power supply of India.
It's hard to even fathom.
We are talking about building enough new power infrastructure to support the most populous nation on Earth, entirely dedicated to running AI servers.
It completely illustrates why Baker Hughes believes the power generation market is merely in the earliest stages of a multi-year supercycle.
We're just at the beginning.
We are. The hyperscalers have access to, frankly, near infinite capital, but their growth is completely throttled by the physical availability of electrons.
They have the money, they just don't have the power.
Right. So Baker Hughes is effectively operating as a toll booth for the AI revolution.
But, the infrastructure challenge of AI doesn't stop at the electrical socket.
No, it definitely doesn't.
Because when you pump 100 kilowatts of electricity into a rack of GPUs, 100% of that energy is eventually converted into thermal energy.
Heat.
A massive amount of heat. And if you do not continuously and aggressively remove that heat, the silicon will literally melt.
Which brings us to what I consider the strategic masterstroke of the quarter.
The Chart Industries acquisition.
Yes, because while the market was distracted by the sheer size of those data center power orders, Baker Hughes closed an acquisition that fundamentally alters their value proposition to these tech companies.
This is where the structural genius of their pivot really crystallizes for me, because they didn't just acquire Chart and bury it inside the IET segment as a bolt-on capability.
No, they elevated it.
They announced that Chart Industries will operate as Baker Hughes's third distinct reporting segment.
Right, alongside OFSE and IET.
Exactly. And that signals to the market that thermal management is now considered a core equal pillar of their corporate identity.
Which is huge. And Chart Industries brings highly differentiated, deeply entrenched expertise in thermal management, air and gas handling, and advanced cryogenics.
Which is exactly what you need when air cooling fails.
Exactly. Because in the context of these hyperdense AI data centers, standard HVAC air cooling is hitting the limits of physics.
You just can't blow enough air.
You simply cannot blow enough cold air fast enough to cool an H100 GPU cluster. The industry is being forced to transition to liquid-to-chip cooling and eventually two-phase immersion cooling.
Where they literally submerge the servers in specialized fluid.
Right. And Chart brings the underlying thermal engineering to make all of that possible.
Simonelli perfectly articulated this synergy on the call. He described it as a turnkey tri-generation solution.
Tri-generation is the key word here.
Right. Baker Hughes provides the gas turbine to generate the massive electrofire needed to run the servers, and Chart Industries provides the extreme thermal management to stop those servers from catching fire.
It's an incredibly elegant engineering loop. Tri-generation, or combined cooling, heat, and power, works like this. You burn natural gas in the Baker Hughes turbine to generate electricity.
Okay.
That process creates massive amounts of high-grade exhaust heat.
Waste heat.
Right. But instead of venting that waste heat into the atmosphere, a tri-generation system captures it, runs it through an absorption chiller, and converts that heat into chilled water.
And then that chilled water is pumped right back into the data center to cool the racks.
Exactly. It drastically increases the overall thermal efficiency of the entire site.
It's brilliant. Because if you were a hyperscaler, deploying billions of dollars into a new campus, you don't want the integration risk of buying your turbines from one vendor, your switchgear from another, and your liquid cooling loops from a third.
And just praying the APIs and the physical plumbing all line up.
Exactly. You want a single throat to choke. And Baker Hughes is stepping up and saying, we will design, deliver, and service the entire power and thermal ecosystem behind your meter.
It's an undeniable value proposition. And while data centers are the immediate explosive growth vector for this acquisition, management was highly intentional about highlighting Chart's footprint across other critical industrial markets too.
Like space and geothermal.
Yes. They see immediate cross-selling synergies in space, geothermal, and metals and mining.
Okay, the space angle is fascinating to me. How exactly does a Houston energy company leverage Chart to sell into the aerospace industry?
Well, it comes down to the handling of extreme molecules.
Explain that.
Chart already has deeply established relationships with major aerospace companies because they provide the cryogenic storage and thermal management systems required for rocket fuel.
Specifically liquid oxygen and liquid hydrogen, right?
Exactly. And storing and transferring these elements at hundreds of degrees below zero requires extreme metallurgical and engineering precision.
So Chart already owns the cryogenic infrastructure at the launch pad.
They do, and Baker Hughes looks at that and says, well, we already build the most advanced compression and fluid handling equipment in the world for the LNG industry.
Oh, I see where this is going.
Right. So we can combine our rotating equipment with your static cryogenic tanks to offer a complete end-to-end fluid management system for space logistics.
That is a massive synergy. And I assume we see a similar logic in the geothermal sector.
Precisely. Geothermal energy involves drilling deep into the Earth's crust to access extreme heat, bringing it to the surface, and using it to drive a turbine.
Which sounds exactly like Baker Hughes' legacy business.
It is. Baker Hughes already dominates the complex well construction and drilling side of that equation from their legacy oil field business.
Okay.
So Chart's advanced heat exchangers and thermal management tech snap perfectly onto the surface operations of a geothermal plant to maximize the efficiency of that heat transfer.
And management actually noted they advanced their geothermal strategy this quarter through an agreement with Mantle Reach Power.
Yeah, aiming to support up to 500 megawatts of geothermal development in North America.
Which is great, but I need to push back here for a second.
Yes, sir.
We spent the last 10 minutes praising the strategic vision of the Chart Industries acquisition. But whenever a CEO starts throwing around words like turnkey solutions and cross-selling synergies,
your inner skeptic wakes up.
Exactly, because corporate history is literally littered with massive industrial mergers where the promised cost savings just never materialize.
Like GE's disastrous acquisition of Alstom.
Exactly like GE and Alstom. The cultures violently clashed and shareholder value was completely decimated.
This is a very fair concern.
And management is projecting $325 million in annualized cost synergies by year 3. That is a massive number. How much of that is actual operational reality versus, investment bankers' spreadsheet magic?
Honestly, it is the most critical risk factor in this entire earnings report. M&A integration is notoriously difficult, especially when you are merging highly specialized engineering cultures.
So how are they handling it?
Well, the management team clearly anticipated this skepticism from Wall Street because they dedicated a significant portion of the call to outlining a highly rigid, accountable integration playbook.
Okay.
They have broken the initial integration into 2 distinct 90-day phases.
So a 180-day plan.
Exactly. The first 180 days dictate the ultimate success or failure of the merger.
What exactly is the mandate for the first 90 days?
The primary mandate right now is stability. They are heavily prioritizing customer continuity, maintaining order execution, and crucially, retaining key engineering talent at Chart.
Basically, don't break what you just bought.
Exactly. They recognize the underlying asset is highly valuable, and the first rule of integration is do no harm. Simultaneously, though, they have established a centralized integration management office to begin executing the structural cost outs.
Okay, so where exactly are they finding this $325 million in savings? What are the specific levers?
The CFO, Ahmed Moghul, broke it down into 3 distinct buckets. The first is SG&A selling, general, and administrative expenses.
Which is where you eliminate corporate redundancy, right?
Yes. This is where you integrate the IT systems, you consolidate the finance and HR functions, and you eliminate overlapping software licenses and administrative overhead.
The standard, albeit painful, corporate bloat reduction. What's the second lever?
Supply chain leverage.
Okay.
Baker Hughes is a massive global purchaser of raw materials, forgings, castings, and electrical components. By folding Chart's procurement into the broader Baker Hughes supply chain, they instantly increase their purchasing volume.
Meaning they can negotiate better prices.
Exactly. That allows them to return to their suppliers and aggressively renegotiate pricing tiers based on that new, larger scale. They also plan to streamline global logistics and freight routing, eliminating redundant shipping routes.
Makes sense. And the third bucket?
Manufacturing and footprint optimization.
What does that look like in practice?
This involves a comprehensive audit of every factory, warehouse, and service center globally across both legacy companies.
So looking for overlap.
Right. If Baker Hughes has an underutilized service center in Houston and Chart is leasing a separate facility 5 miles away.
They just merge them.
Exactly. They will consolidate those operations under one roof, terminating external leases and maximizing the utilization rate of their own real estate.
And they did provide a very specific glide path for these savings, which I appreciated. They aren't just waving their hands and pointing to year 3.
No, they have benchmarks.
They're targeting $95 million in realized cost savings in year 1, scaling up to $230 million in year 2 before hitting that full 325 million run rate in year 3.
And those phased financial targets provide Wall Street with a highly measurable scorecard.
Right, so we can track their progress.
Exactly. If they miss that $95 million target in year 1, the market will severely punish the stock because it will signal that the integration is faltering.
But if they execute?
If they execute, that $325 million flows almost entirely to the bottom line, significantly boosting their consolidated free cash flow profile.
Okay, so we've thoroughly dissected the AI data center narrative, the explosive IET growth, and the Chart acquisition. But we cannot analyze Baker Hughes without examining the foundation of the company.
The legacy business.
Right, the oilfield services and equipment division. Because while the tech pivot is the growth engine, the legacy oilfield business is the massive cash cow that is funding this entire transition.
It absolutely is.
And frankly, Office had an incredibly resilient quarter in the face of severe macroeconomic and geopolitical headwinds.
Resilience is the exact right word. The Office division delivered $3.45 billion in revenue for the quarter.
Which is a 7% sequential increase.
Right, and that actually came in above the high end of their guidance range for the division.
And a 7% sequential beat in the middle of Q2 2026 is phenomenal when you consider the operating environment. I mean, they are navigating extreme, ongoing geopolitical disruptions in the Middle East.
Which is traditionally one of their highest margin, highest volume regions.
Exactly. I noticed in the filings they are dealing with severe logistics, bottlenecks, rerouting freight, and navigating localized operational paralysis.
It's a very tough environment.
So how did they manage to grow the top line by 7% with the Middle East in turmoil?
It is a testament to the geographic and product diversification strategy they have executed over the last 5 years.
They aren't just reliant on one area anymore?
Right. They are no longer completely beholden to the rig count in a single basin. While Middle East activity was challenged, they saw tremendous seasonal recovery and project execution in offshore and international markets.
Like where?
Specifically, they highlighted massive wins in Latin America, Asia Pacific, and the North Sea.
Oh, right. They cited a major award from Petrobras in Brazil for well construction solutions across the pre-salt Santos Basin.
Which is no small feat.
No, drilling in the pre-salt layer offshore Brazil is some of the most technologically demanding engineering on the planet. You were dealing with extreme pressures, highly corrosive environments, and super deep water.
And in Europe, Equinor expended critical contracts for integrated drilling, well services, and wireline intervention across their Norwegian continental shelf operations.
So the common thread here is that Baker Hughes is winning the most complex mission-critical offshore work globally.
Yes, and the subsea production systems, or SSPS, was a massive bright spot.
What were the numbers there?
That specific subsegment saw its revenue jump roughly 10% sequentially, and crucially, the SSPS margins recovered back into the high teens.
The margin recovery in SSPS is significant because subsea equipment is incredibly capital-intensive to manufacture. Right?
Very. And they secured $667 million in new SSPS orders in the quarter, which represents a 29% year-over-year increase when adjusted for the recent joint venture changes. They highlighted awards for Azul Energy's ultra-deepwater development offshore Angola and a major offshore gas development in Brunei.
You know, this offshore expertise actually provides a brilliant thematic bridge back to their IET success with the data centers.
How do you mean?
Think about it. When you build subsea trees and blowout preventers that have to operate flawlessly under thousands of feet of crushing ocean pressure for 20 years without maintenance.
You develop a very specific type of engineering culture.
Exactly. You develop a corporate engineering DNA centered on extreme reliability. We're talking 99.999% uptime.
Right.
That is the exact same reliability standard demanded by hyperscalers running billion-dollar AI training runs. The industrial rigor required to survive the North Sea is what allows them to guarantee uptime for a Microsoft data center.
That is an excellent synthesis. The underlying engineering competencies, fluid dynamics, rotating equipment, advanced metallurgy, and zero defect manufacturing, they are entirely fungible between a deepwater drilling rig and a 1.3 gigawatt captive power plant.
The tech is the tech. But let's go back to the Middle East for a moment.
Sure.
Because while Brazil and Angola clearly carried the growth, I want to know how badly the Middle East disruptions actually hurt the bottom line.
Yeah.
Did revenue completely fall off a cliff in the region?
Fascinatingly, it didn't.
Right.
The CFO explicitly noted that their product revenue in the Middle East actually exceeded their internal expectations.
Despite everything going on.
Despite the chaos, their supply chain and logistics teams managed to secure the freight capacity to deliver critical drill bits, artificial lift systems, and completion tools to their customers.
Meaning they navigated the bottlenecks, but I assume that logistical heroism wasn't cheap.
Exactly. It definitely wasn't cheap. The revenue held up. Overall, EPIC revenue in the region only declined 1% sequentially, but it came at a cost.
Rate cost.
Right. Securing emergency freight and rerouting supply chains in a conflict zone drives up logistics expenses significantly. So while product delivery remained robust, the localized margin within the Middle East experienced pressure due to those elevated costs, compounded by a slight softening in high-margin service activity.
So Middle East revenue is down roughly 10% from its absolute peak in late 2025, but it appears to be stabilizing.
Yes.
Did those elevated Middle East freight costs drag down the profitability of the entire OFSE division?
No, actually. The strength of the international offshore markets completely insulated the broader division. Overall, OFSE reported EBITDA was $605 million, again beating their high-end guidance.
Okay, so they still beat.
Yeah, and the divisional EBITDA margin actually expanded by 10 basis points sequentially to 17.5%. The high teens margin in the subsea business and the strong pricing in Latin America easily absorbed the localized cost inflation in the Middle East.
It really proves the resilience of their portfolio. But there's one more legacy energy market we have to cover.
The LNG market.
Yes, because it is acting as the ultimate bridge between the old fossil fuel economy and the new AI-driven power paradigm. And that is LNG, liquefied natural gas. We talked earlier about the $7.1 billion in total IET orders.
Right.
$2.2 billion of that was data center power. But a massive $1.8 billion of that quarter's orders came strictly from LNG equipment across 3 major mega projects.
Which is a huge chunk. The global build-out of LNG infrastructure is a multi-decade structural megacycle, and Baker Hughes effectively owns the technological high ground in this space.
Because they provide the most critical parts, right?
Exactly. They provide the most highly engineered components of a liquefaction facility.
They highlighted a massive, sweeping award from Venture Global on the call. And the scope of this project is almost hard to conceptualize.
It's massive.
6 LNG blocks comprising 12 full liquefaction modules. Baker Hughes is providing the advanced centrifugal compressors, the cryogenic cold boxes, the air coolers, and the integrated digital control systems.
And to understand the barrier to entry here, you really have to look at what a cold box actually does.
Break that down for us.
So, to turn natural gas into a liquid so it can be shipped on a tanker, you have to cool it to negative 260 degrees Fahrenheit.
Which is insanely cold.
Right. The centrifugal compressors, which are driven by massive gas turbines, pressurize the refrigerant, which then flows through a complex matrix of aluminum heat exchangers inside the cold box to freeze the gas.
Okay.
The thermodynamic tolerances involved in this process are microscopic. There are only a handful of companies on Earth capable of manufacturing these systems at scale.
And Baker Hughes is the undisputed market leader.
They absolutely are.
They also secured a major order from Golar for a floating LNG facility, providing 4 aeroderivative gas turbine-driven refrigerant compressor trains.
Yeah. That is the 4th Golar vessel to utilize Baker Hughes tech.
Plus, they had multiple awards supporting the Sabine Pass LNG expansion. But I have to ask, why are we seeing billions of dollars continually pouring into natural gas infrastructure when the broader political narrative is entirely focused on the transition to renewables?
Well, the CEO actually dedicated a significant portion of his macro commentary to explaining this exact dynamic.
What's driving it?
Geopolitics. The geopolitical shocks of the last 4 years fundamentally and permanently altered the global energy map. When Europe lost access to pipeline gas from the East, it triggered an existential economic crisis.
Right.
The immediate brutal lesson was that energy security is synonymous with national security.
Yeah, you cannot run an advanced industrial economy on wind and solar alone if the base load power isn't there when the sun goes down. Yeah. And if you rely on a pipeline crossing a hostile border, your sovereignty is compromised.
Exactly. And LNG solves the geographic vulnerability of the pipeline. By liquefying the gas, it becomes a globally traded fungible commodity.
Well, you can buy it from anywhere.
Right. A regasification terminal in Germany can accept a tanker from the U.S. Gulf Coast on Monday and a tanker from Qatar on Thursday. That supply chain flexibility is the ultimate insurance policy against geopolitical blackmail.
And management believes this demand curve is nowhere near peaking.
Their internal projections indicate a clear path for global installed LNG nameplate capacity to approach 800 million tons per annum by 2030.
Wow.
And scaling up to roughly 950 million tons by 2035. That growth is underpinned not just by European energy security, but by the massive expansion of natural gas consumption in emerging markets across Asia.
Because they're moving away from coal, right?
Yes. They are aggressively shutting down highly polluting coal-fired power plants and replacing them with cleaner-burning natural gas baseload power.
And the numbers definitely validate their conviction, because through just the first half of 2026, Baker Hughes has already booked $2.9 billion in LNG equipment orders.
Just in 6 months.
Right. That 6-month total exceeds their entire full-year LNG order intake for 2025. The acceleration is just violent.
It really is.
Okay, so we have a complete picture of the operational reality. We understand the AI data center power pivot, the chart industry synergy, the resilience of the offshore oil field business, and the massive LNG megacycle.
Which brings us to the most critical section of any earnings analysis.
Management guidance. Where do they see this going in the back half of the year?
Well, because of the sustained strength across both main divisions, management comprehensively raised their full-year financial guidance.
Okay, hit us with the numbers.
They now anticipate total company revenue for 2026 to reach $27.35 billion. And they increased their full-year adjusted EBITDA guidance to a midpoint of $4.85 billion.
But the truly eye-popping guidance revisions happen within the IET segment.
Yes, they raised the full-year IET revenue guidance to $13.5 billion. However, the order guidance is what really caught my attention.
What have they extended to?
They extended their full-year IET orders guidance to a massive range of $17.5 billion to $19.5 billion.
If they hit that range, it will mark the second consecutive year of record-shattering order intake, which drastically extends their revenue visibility well into the end of the decade.
And management didn't stop at the 2026 numbers. They updated what they call their Horizon 2 targets, their long-term structural goals.
What's the new target?
They raised their total Horizon 2 IET orders target to more than $45 billion.
$45 billion in target orders. Okay, this is where we need to introduce a heavy dose of reality for retail investors listening to this deep dive.
Yeah, we need to temper expectations slightly.
Because if you see a company book $12 billion in orders in the first 6 months and raise their long-term target to $45 billion, the natural retail instinct is to assume that revenue is going to instantly explode on the income statement in Q3 or Q4.
Right, like it's going to show up tomorrow.
Exactly. But management spent a significant amount of time on the call meticulously managing that exact expectation.
Yeah.
They used a very specific phrase. They warned that these massive orders will convert to revenue at a measured pace.
A measured pace. It is a critical caveat.
Explain that dynamic.
The measured pace is dictated by the physical reality of heavy manufacturing, which they refer to as cycle times.
Cycle time.
Right. When a software company signs a $100 million enterprise contract, they can often begin recognizing that subscription revenue almost immediately.
Because there's no physical product to build.
Exactly. But when Baker Hughes signs a $1.3 billion contract for gas turbines and LNG cold boxes, the revenue recognition is tied to physical manufacturing milestones.
Right. You don't just pull a 1.3 gigawatt turbine off a shelf in an Amazon fulfillment center and, overnight it to a data center.
I wish. No, it requires months of securing specialized forgings, precise metallurgical casting, rigorous assembly, and extensive testing before it ever leaves the factory floor.
It's a massive physical undertaking.
It is. Because of the complex engineering and the sheer scale of the equipment, the cycle time for a heavy-duty gas turbine or a major LNG compressor train can be anywhere from 18 to 36 months.
18 to 36 months from the moment the purchase order is signed to the final commissioning on site.
Exactly. Therefore, management was very explicit that a highly meaningful portion of the $7.1 billion they just booked in Q2 will not actually convert into recognized revenue on the income statement until late 2027, 2028, and beyond.
So if you're an investor buying the stock today, expecting a massive symmetrical spike in Q4 revenue because of the data center headlines,
you are fundamentally misunderstanding the accounting mechanics of the business.
right. The cash is largely guaranteed, the contracts are legally binding, and it is safely locked in the RPO backlog. But you have to have the patience to wait for the manufacturing cycle to play out.
However, the delayed revenue recognition comes with a massive silver lining regarding profitability.
What's the silver lining?
Because these orders were secured during an environment of unprecedented demand and constrained global supply, they carry exceptionally strong pricing dynamics.
Meaning Baker Hughes dictated the terms.
Yes. They sold these turbines at a premium margin because the hyperscalers literally have no other alternatives and cannot afford to wait.
That's huge.
It is. Management expects that deeply embedded pricing strength, combined with their ongoing operational efficiencies and the upcoming Chart integration synergies, to provide a highly favorable multi-year tailwind for IET profit margins.
Starting when?
Starting in 2027 and accelerating through the end of the decade.
But this introduces a massive operational bottleneck. Let's do the math here.
Okay.
They are targeting $45 billion in Horizon 2 orders. Their book-to-bill ratio is 2.2. They're physically selling equipment twice as fast as they can build it.
Right.
Does Baker Hughes actually have the factory capacity to manufacture this volume of turbines without buckling under the weight of their own success? Or are they going to be forced to spend billions of dollars building brand new mega factories? Because if they do, that would completely destroy that $1.1 billion free cash flow profile we praised earlier.
Yeah, it would tank their cash flow.
Right. I would be incredibly nervous if they announced a massive multi-billion-dollar CapEx program to build new facilities from scratch.
Well, the analysts on the call shared that exact concern. A JP Morgan analyst directly pressed the CEO to detail their capacity expansion roadmap through 2029.
And what did they say?
Management's response was highly disciplined. They are explicitly avoiding the trap of building massive, expensive, new greenfield megafactories.
Okay, but then how do you double your output without building new factories?
They are executing what they call a roofline optimization and a make-buy strategy.
Roofline optimization, what does that mean?
First, they are maximizing the utilization of their existing global manufacturing footprint. So they are adding additional shifts, upgrading their internal machining tools for faster throughput, and optimizing the floor layout using advanced manufacturing techniques.
Basically increasing the velocity of production within the buildings they already own.
Exactly, sweating the existing assets.
And the make-buy strategy.
It's a ruthless focus on core competencies. They are keeping the manufacturing of the most critical, highly engineered, proprietary components strictly in-house.
To protect their IP and ensure quality control.
Right. But they're actively partnering with a network of strategic, qualified suppliers globally to outsource the manufacturing of non-critical subassemblies and standardized parts.
Ah, I see.
By leveraging external supply chains for the lower margin components, they drastically increase the final assembly capacity of their own factories without spending the capital to build new foundries.
That is a brilliant capital-light way to scale.
It really is. The CEO noted they expect their gas turbine capacity to essentially double from 2026 levels by the end of 2028.
With the first wave coming online when?
In the first half of 2027. And they are targeting a payback period of less than 2 years on the surgical capital expenditures they are making to upgrade those existing lines.
A sub-2-year payback period implies that the profit margins on those incremental turbines rolling off those upgraded lines are extraordinarily high.
They are. They are expanding capacity to support what they estimate could be nearly $5 billion in annual power systems revenue by 2029.
Which is massive.
To put that in perspective, even if you assume a conservative utilization rate below their maximum capacity, that represents a revenue stream that is 3 to 4 times larger than what the power systems business generated in 2025.
Wow. All right, let's look at the immediate near-term guidance. Just to round out the data picture, what are they saying for Q3?
For the upcoming third quarter of 2026, they are guiding for total company revenue of roughly $6.87 billion and adjusted EBITDA of $1.205 billion.
And did they mention the geopolitical assumptions underpinning that guidance?
They did. They are modeling that the current activity levels in the Middle East will remain broadly unchanged through the end of the year.
So no better, no worse.
Right. Under that scenario, they expect off-SE revenue in the region to remain flat compared to Q2 levels, while the IET segment will continue to face a modest 1% to 2% revenue headwind due to the localized logistical frictions.
They also assume that global freight rates and supply chain conditions remain stable at current levels, right?
Yes, but they attach the obvious caveat. Any material escalation or de-escalation...
We really did. We have the underlying strength of the Q2 financials. We understand the mechanics of the AI data center power pivot, and the strategic necessity of that Chart Industries thermal management acquisition.
Right.
We see the cash-generating resilience of the legacy offshore oil field business, the multi-decade runway of the LNG megacycle, and we've mapped out the disciplined capital-light strategy for capacity expansion.
All to digest that massive $37 billion backlog.
Exactly. Which brings us to the final, and definitely most important, phase of our deep dive.
The verdict.
The verdict.
Right.
We have laid out the data. We have translated the operational mechanics. Now, we need to synthesize this into an actionable conclusion for the retail investor. Based on this massive trove of information, what is the bottom line on Baker Hughes stock right now?
From a purely analytical standpoint, weighing the massive structural tailwinds against the execution risks of the M&A integration and the geopolitical volatility, this earnings call represents a strong bullish signal.
I agree with that assessment, but I want to be incredibly precise about the why for our listeners. Because acting on this bullish signal requires you to completely rewire your perspective on the equity.
It really does.
If you are holding BKR or considering establishing a position, you can no longer evaluate this company through the historical lens of an oil and gas services stock.
That is the critical takeaway. Historically, the market assigns a relatively low valuation multiple to oilfield services companies because their revenue streams are deeply cyclical.
They rise and fall violently with the spot price of a barrel of crude oil.
Exactly. If oil drops to $50 a barrel, upstream capex evaporates and service companies bleed cash.
But the explosive growth of the IET division is fundamentally decoupling Baker Hughes from the price of crude oil.
That's the pivot.
When you buy BKR today, you are buying a highly diversified, advanced engineering conglomerate that has perfectly positioned itself as the dominant pick and shovel provider for two of the most significant capital-intensive macro trends of the next decade.
The global build-out of LNG infrastructure for sovereign energy security.
And the staggering, power-hungry expansion of artificial intelligence data centers.
They are expanding their manufacturing footprint to support a $5 billion annual power systems revenue run rate by 2029.
They just acquired the missing thermal management puzzle piece in Chart Industries, allowing them to offer a fully integrated, turnkey power and cooling solution.
To hyperscalers who are desperate for grid-independent infrastructure.
Right. And that $37.1 billion RPO backlog provides a level of guaranteed revenue visibility that most industrial companies can only dream of.
But again, you absolutely must accept the reality of the measured pace of revenue conversion.
Yes, patience is required here. This is not a stock that is going to double on the next earnings print because of a sudden software-like revenue spike.
The physical cycle times dictate that the massive cash flows from these data center and LNG orders will realistically start hitting the income statement in late 2027 and scale massively into 2028.
But the demand's contractually locked in. The margins are structurally expanding due to pricing power, and their capital discipline regarding factory expansion is highly rigorous.
It is, at its core, a next-generation infrastructure play operating under the disguise of a legacy oil field ticker.
It really is. And that brings me to a final thought I want you to mull over as you think about how to position your portfolio for the rest of this decade. We noted earlier that power spending by the largest hyperscalers, the Microsofts, the Googles, the Amazons, the Metas, is expected to essentially double.
Increasing from approximately $370 billion in 2025 to nearly $750 billion by 2028.
$750 billion desperately searching for physical infrastructure to support AI computation.
And as we've established, the traditional public utility grid simply cannot absorb that influx of capital or deploy that sheer volume of electricity fast enough to meet their timelines.
Exactly. So here is the provocative thought to leave you with. As these trillion-dollar tech giants scramble for grid-independent, behind-the-meter power to fuel their AI ambitions, are we about to witness a fundamental re-rating of these heavy industrial companies by Wall Street?
It's very possible.
Will legacy heavy metal manufacturers like Baker Hughes, who provide the physical fire to generate the electricity and the extreme ice to prevent the servers from melting, actually become the stealthiest, most lucrative tech stocks of the next 10 years?
It completely shatters the initial framework we used to view the company. I mean, you think you were looking at the financial plumbing of a fossil fuel operator.
But when you look at the actual mechanics of their backlog, you realize you're looking at the physical foundation of the AI revolution. Thanks for joining us on this massive deep dive. We'll catch you on the next one.